Welcome back to the channel. I see a couple of you here. Give me a minute. Let me just turn on the comments or make sure the comments are being turned on. And so today we'll basically be talking about, the framework that we have used to look at companies so far. And then basically from there, we are going to see what are some of the changes we have made to the framework that we have used last week. Then uh, moving forward, this is how we are going to look at companies. So today we'll be taking companies like Nvidia through this framework, as well as SOFI and HIMS, and to actually see how this has changed for these companies over the last couple of months or last couple of weeks. I think especially with HIMS and SOFI, because I was focusing on talking about the 10 companies over the last 2 weeks. So because of that, I haven't really given a lot of coverage over these two companies, and that's what my focus will be in this week moving forward. Okay, so today, I think very basically, we want to talk about the framework. We want to talk about how we have looked at SOFI, or how we have decided to invest in SOFI previously, as well as how we decided to invest in HIMS. And then I'm also going to take a company like Nvidia through the framework and to show you that this is a robust framework, and it's not just any old company that you put inside, you'll get a good score. Right, so that it really does take into the nuance as much as possible about the different companies out there. And so it's actually quite different from what we have done previously. Uh, and I think I may take one or two of those companies through this framework again, especially the ones that I have been interested in. So later on this week, I think this week I'm going to cover 4 companies in particular over the next 3 days, apart from today. So today we won't be going in depth into any of these companies, but over the next 3 days, I hope to redo SOFI's valuation based on the expectations that we have around their crypto announcements, and then I hope to redo the valuation for HIMS after you discount the Novo Nordisk partnership, and then at the same time, I also hope to talk about Grab. I think this Grab one is something that people have been interested in for quite some time. And finally, the last thing I want to do is to talk about my recent options position in Lululemon. So let me just let you have a glimpse at where the portfolio stands right now before we get started, and you can have a better context of why I'm talking about certain things. You see, every time I share this portfolio, right, I'm always not sure whether or not how much you guys can actually see. Like, are the numbers here at the bottom? Uh, yeah, can everybody see the numbers at the bottom? I'm not very sure. So I will do my best. I think this is the most I can do. So you can see in the portfolio over here, today the value stands at around $643,000. We currently have a couple of positions. We have SoFi, Oscar, Grab, HIMS, BMNR, as well as Lululemon. Now, BMNR is a fairly new position. I think I've opened it in the last couple of weeks after listening to a bunch of Tom Lee's uh, podcasts. But I think the one particular podcast that made me really like flip a switch in my head to make a move is actually not a Tom podcast. I'm not. You guys have heard about the podcast Bankless. Let me show you. Have you guys heard of Bankless? I think they are a brilliant podcast. I think that was the first time that I really understood the bull case for Ethereum and how tokenization works. Some of the problems with tokenizing real world assets, because I think if you are on FinTweet in general, I think it's very easy to, get sucked into the hype of, everything is going to be tokenized and things like that. But it is not so simple. Tokenization itself brings about a certain complex set of problems. And I think this discussion in Bankless, I'm not going to show you the whole podcast. It's over an hour long. I'll link it down below in the description. But I think this particular podcast really, really opened my eyes to some of the problems and how it can be fixed. So this particular episode was actually two. Okay, let me share my screen with you. I think it's good morning, everybody. Welcome, welcome. I can see that there are 14 of you over here. Do let me know if you can type in the comments. The last week when I tried to stream, there were certain times where the comments were okay, sometimes they were not. All right, so let me bring you across to. So I've really been, oh, you can see, yeah, I was, okay, so you can see, I've been listening to the podcast the guys at Bankless are doing, and it's this particular one that says the third one over here, crypto professors debate. And in this debate, I think the two sides of it is the arguments here are very simple. If you tokenize things, they were referencing things like the buyback. So they gave a edge case scenario of what if the North Koreans hack into your grandma's uh, hack into the Ethereum network and then steals your grandma's house. So are they allowed to be able to move into your grandma's house and things like that? Or if they tokenize Apple shares, will they then be able to put a person on the board of Apple if they hack away some of the if they hack into the Ethereum network and things like that? So there was a back and forth debate over how to tokenize the real world assets in a way that works. And I think you can see the both of them have a very different framework, they're very different ideology. And I think that robustness of the discussion between the two of them, at least to me, signals that that there's going to be a progression in that way. And then these are some of the problems that people are already starting to think of. I think when we look at it, you can't say that, oh, because there's a problem, this will not happen. I think the fact that these two professors are already debating about it to such extent, I had to listen to the podcast twice because certain things that you just have to listen again to try and understand where they were coming from. So that is why I started a position in BMNR. I expected to be assigned some of the shares, but yeah, I mean, looking at it, I'm not too sure. Basically, maybe I will. You can see over here, I'm literally playing the volatility with this. Let me just show you how I'm actually playing this, because I really want to own the shares, but I just don't want. I mean, I bought some outright, but I don't want to buy so much of it outright. So let me show you. So let me talk you through my positions. I think this is the first time I'm actually like showing it proper. These are all my positions over here. And basically BMNR, you can see the first line over here. I'm so sorry if you can't see this because I'm not too sure at the moment how to make this screen bigger. I don't think you can. Can I? I mean, if anyone knows how to make the screen bigger, feel free to let me know. But the first line you can see, I have 12th of September. That means this Friday. $43 cash secured puts on BMNR, 5 of them. So that's around 500 shares. Received $2.08. And then currently it's at $1.40. Why? Because BMNR is above $43, right? Earlier on today, it was $44. So this was a lot lesser. So I would be happy to buy this 500 shares here. Why am I happy to buy these 500 shares here? Because I have another 100 shares bought at around $42. These shares are basically, uncovered in a sense. There's no option strategy on them. And then I bought another 200. And this one, I admit, I was just testing it out to see the volatility, and I mean, it was quite decent. I bought this sometime last week. So basically, with 200 shares, I basically sold, two covered $1.27, $250. $250 out of an $8,000 position in a week. I think that is fairly good. 250 divided by what's this? Let's call it 8,007. You get 2% per week. $1.27 out of, is it 1,227 divided by, sorry, 3.13. Yeah, you got 2.9% return per week. So I was literally just playing the volatility over here. So you can see 12th of September, if BMNR somehow or other ends up between 43 and $45, I would keep the entirety of both premiums. Otherwise, the BMNR, these 200 BMNR shares will be called away at $44. I would, make the $200 profit plus whatever options are over here. Then I'm just going to sell another cash put next week to get these shares. I am interested in building this position up to 1,000 shares or so. And then basically I'll just be very aggressively rolling the wheel strategy from here. Now, granted, next week I will be overseas in Canada. So hopefully I'm able, not hopefully, I will definitely live stream when I'm in Canada, but I will likely be doing it in the same time zone as most of you, right? So we'll still be talking about the options positions when I'm overseas because I'll be looking at them. And then with HIMS, this is fairly straightforward. I think I've closed out my $80. Okay, I think I have it over here. Where was it? Okay, you can see over here, if you can see the one that I've highlighted, yesterday I've closed out my $80, 19th of September, $80 HIMS calls at 10 cents. And can I just look for HIMS? I think for those of you, I think you might have seen this before. $80 HIMS, $80. Where is it? HIMS, this is 39. Anyone knows a faster way to search this? Can I do? Can I Control F this? No, I can't. Sort by symbol. Okay. Yeah. You can see I got in these 10 covered calls for HIMS, $80, 19th of September at $4. So this is actually $4,000 worth in premiums. This was in, I think, early August, right? So I've just closed it for 10 cents, which means I realized about $3.90. The reason for that is because over the last 2 days, HIMS started to run, and I don't want to be caught in a position if HIMS really continues to run. And then I've already been so profitable in this position to actually risk it for that last 10 cents. So I decided to close that position out. So you can see out of the $4,000 in premiums, we have kept around $3,900. Hi, Wen Chang from Taiwan. Wow, okay. Is it really rainy in Taiwan right now? Because in September, it usually gets rainy. I think one of my close friends is actually from Taiwan. So he has always told me, not to visit Taiwan in September because it gets, really rainy and all that over there. Typhoon season or something like that. So because of that, I have never visited Taiwan in September. Yeah. Yeah. So that's the BMNR position, very aggressive, rolling, wheeling it, and then the HIMS position closed out on a covered call at from $4. I closed it out at 10 cents, so we realized $3,900 in premiums, and then we have the 19th of September $45 cash puts. We received $2 per contract, and then now it's currently around $1.12. Might decide to close this out earlier on. I'm not too sure about this. I mean honestly, I just want HIMS to become a 2,000 share position. So the way I try and report for is that there are certain companies like BMNR where I'm going to aggressively run the wheel strategy. These companies tend to have a lot more volatility and they supplement most of my income. HIMS is one of those companies. However, with HIMS, it's slightly more nuanced because I really believe in the long-term trajectory of the company and where medicine and healthcare is going in general. At least I believe in their vision of healthcare. So I want to be invested in this company, and how I am doing it is that hopefully I will build this out eventually to a $2,000 position. Right, this $2,000 position, around half of it, I will be running the wheel strategy on it. The other half, I'll be holding, not running the wheel strategy on it in any case. Palantir, HIMS, and SOFI. Wow, okay. You know what? Those are really fantastic companies. I wish I haven't sold out of my Palantir earlier on. Later, I'll show you the second account. I sold out of Palantir 3 times, and each of the 3 times regretted it. But of course, it lowered my cost basis. I currently only left, I think, around 100 or so shares of Palantir in one of my accounts. So it could have been my biggest position, but now currently SOFI is my biggest position. Okay, you can see over here, well, this is, in a sense, I guess it's kind of painful. I expected Lululemon to post poor earnings. And if you followed the 10 companies in 10 days, I said that Lululemon was the company that I wanted to get into if you compare to Nike and Ons. Reason is because of the trajectory of the company in Asia itself. I'm still seeing a lot of adoption in Singapore. When I went to China, I saw a lot of people going, I saw a lot of people wearing Lululemon, and I believe in their most recent earnings, if I'm not mistaken, I haven't looked into it in exact detail. I will by tomorrow. That China was the main region driving their growth. So I think that growth story in Asia is really underappreciated by the media. That is not to say there is no competition. I believe, I mean, I learned about, in Singapore, we have our own local brand called Hydra. I'll show you the brand when I'm covering Lululemon more in detail, but they are definitely a competition for in this space as well. And so you can see this cash account put is down 179%. I think when you do cash account puts, sometimes these kind of things look worse than it is. All it means is that I have to buy 100 shares of Lululemon at $190. So that's what, $19,000, right? Out of that, I've already received $800. So basically my average cost of Lululemon will be around $181, which I think it's a fairly decent price to be paying for them. Currently, they're sitting in the 160s. All I will be doing is that the moment I get assigned these shares on 19th of September, I will start to sell a covered call over these shares and lower my cost basis even further. So I think for me, Lululemon is actually a trade, more like a Nike kind of trade and not so much a long-term investment. So I will be selling pretty aggressive covered calls on these, and I wouldn't mind them being called away. I'm buying them at $190. My average cost basis is around $181. So I will be selling covered calls probably in the around 180. And then from there, I will roll it out if it really bounces back that quickly, right? Then the next position that we have over here, United Health. We have 17 December. We have $400 strikes for 17 December 2027. So we bought this. I think some of you saw when I mentioned it previously. I initially started off with 20 leads on, but I sold at around $45 in order to pay for part of my parents' retirement income, and then I left the other 10 over here. These are now around $49. So I plan to completely exit this position once this doubles again, which means once this reach $80. And the reason for that is because I need to pay for renovations. So that is where this money is going. And then I'm not in urgent need for the money for renovation right now. It's going to be a 2026 thing. So as long as United Health reaches 360, I believe, I can't remember what was the number. I think around 360 by February next year, we are fine. Otherwise we'll have to redo the calculation. And then with Grab, I only own 5,000 shares. And the reason for that is because if a company is illiquid, it's a bit hard for me to run the real strategy. And because my income is dependent on the real strategy, if this grows into a bigger position, fine, but I'm not going to be allocating, more than 10% of my money into a position where I believe, despite of the long-term growth, as long as it's a little bit hard for me to run the real strategy, it's a little bit hard for me to hold this right now, right? I am open to get this to perhaps 8,000 shares, but I think that's the max that I will cap it at. Okay, SOFI is my biggest position. I have 19 September cash account puts for $23. Why I did that? Because I sold 10. I sold 1,000 SOFI shares a couple of weeks ago, again to fund my parents' retirement income for the next maybe I think 12 to 18 months. And so because of that, I didn't want to I sold the 1,000 shares and then I sold the cash account put to buy back the 1,000 shares later on, right? So I thought when I did. I think SOFI was at $24, but seems like we are not getting a sign unless things change drastically, because I am expecting news of a rate cut. And then with that, we have $29 SOFI covered calls. You can see this is what I've been doing. I have 6,000 shares over here. These shares are uncovered. The 5,000 SOFI shares over here are covered with a covered call. These covered calls expire again, everything on 19th September. Why 19th of September? I think I've said previously, I'm going on holiday 16th of September. I want to close everything before then. And I'm a little bit greedy. I could have closed everything 12th. I decided not to because I can do it on the 15th or 16th itself. So 19th September, covered calls. End of this week, I'll probably close it so that I wouldn't have to worry next week. Or I might, and then depending on the price of where SOFI is, because today is down, I might just sell another covered call in the $30 range. So like I said, the way I run this portfolio, for half of the position, I will not touch at all, which means these 6,000 SOFI shares, these 6,000 will not be sold until the thesis changes or until I find a better opportunity. For the other half of the position, I run a covered call strategy so that it generates income for me, and then I use the cash on hand to run a cash put strategy, right? Oscar, similar. Okay, you can see the covered calls are underwater today. I got around 50 cents for it. Currently, it's at 60 cents. But again, I have 5,000 shares of Oscar at $15. And basically, the 3,000 shares are uncovered. And then the last 2,000 shares will be covered by these covered calls, expiring 19 September, $21 strike. Right? So a lot of these will be closed by the end of the week. I'm not too sure how the market will react after the cuts by the Federal Reserve. So I think we're going to see how it reacts, and then we'll adjust it accordingly. I think people are worried about a September crash or correction in the market because the market has really been going up non-stop. I think there's a part of me that's also wanting to hedge that, which is why I'm selling all these covered calls. So I am prepared if some of these positions get called away. Hopefully not by the end of this week, because I plan to close everything by either Friday or Monday. Right. So I think with that is the entire portfolio, I believe. Yeah. So I don't think there's anything else to see over here. So this is basically a portfolio. That's how I run it. I run a very aggressive covered call strategy on positions like BMNR. It's fully to maximize the volatility over here. So best case scenario, I end up with the 800 shares of BMNR. I'll buy another 200 more to make it 1,000 shares. Then I can run the build strategy effectively. If it really ends up between 43 and 44 by the end of this week, I will just keep the premium and then I'll do it again next week, right? Until one day I get assigned the shares. So I'm not in a hurry. Even if it runs, I am not worried because I have a crypto portfolio where I actually buy Ethereum. So to me, BMNR is purely because I believe in the Ethereum trajectory, and I also want to milk the volatility at the same time. With HIMS, it's actually HIMS was supposed to be my second largest position, but now Oscar has grown to become my second largest position after the recent run. And I think that is largely because of the fall from $60 range for HIMS. So with HIMS, there's no change over here. I'm still expecting them to do well going into 2026. I think if no Novo Nordisk partnership, I think that's actually even better for them because there's no overhang of the will they, won't they in terms of the legal lawsuit and things like that. So half of that is being covered by a covered call, similar to SOFI. Believe in it. Half my position covered by covered calls. Right, the other half going to leave it there. I am likely going to be assigned 100 Lululemon shares, going to be rolling them until I can roll it profitably. I'm not opposed to holding them long term. Unlike United Health, I think with United Health, I was a lot more confident about the trajectory of their recovery because I know as long as they increase the premiums, profitability will come back in 2026. And because the markets are a forward-looking mechanism, the markets will already start pricing in profitability sometime in 2026 for the 2027. So that's why 17th December 2027 calls, to me, I felt really, really safe. However, for Lululemon, it's a bit different because if you listen to McDonald, which is the CEO, he actually tells us that, we are going to roll out a lot of new products next year in 2026. And I think spring, when is spring? That's probably like Q2 of next year in America. So because of that, I think we will only see the recovery happen towards the back half of 2026, going into 2027. And at the time when I sold these cash or cap puts, I believe the furthest away call I could buy was January 2027, which is still a little bit too close for comfort. Now, recently, I think last a couple of days ago, I noticed the December 2027 calls for Lululemon has come out onto the market and come out. So that is something I'm definitely going to be considering as well, to see whether I want to do that. So yeah, real strategy leaps. That's basically how I run most of the portfolio. Uh, there are two names missing here, which I've never ever. I think because of timing in terms of my liquidity, I've actually managed to get into companies like Robinhood and C Limited. These are two companies that I'm really interested to open a position in. And I'm looking to buy them on certain pullbacks. So, for example, recently I know Robinhood pulled back before the announcement of the S&P 500, but because I have all my cash, you can see the cash here is around 110,000 in cash, which is around slightly less than 20% of the portfolio. And I think for me, I think for me, the reason why I haven't gotten into Robinhood is that because every time there's a suitable buying opportunity, my cash tends to be locked up in other things, right? So I haven't necessarily, always, in the sense, got the timing right to buy Robinhood and even C Limited. So that's where we stand at the moment. And I think I will be doing more of these reviews of the portfolio, talking about how I got into some of these positions. And hopefully from there, we can have a discussion about how to manage a portfolio going forward. Now, I'm going to take you through very quickly the framework that we are using, and I'm going to discuss how I came to the decision to make SOFI such a large part of my portfolio, as well as HIMS. So the reason why I thought this was important is that because when I first started investing, I noticed that certain things in Palantir, but the reason why I sold out of it is that because I didn't really have a way to think things through very clearly. Everything was very arbitrary. So over here, the main changes that you are going to notice compared to what we have done previously, right, is basically we are going to consider the market cap of the company as well. So again, for those of you who are perhaps seeing this for the first time, this is basically 7 steps that we use to look at whether or not the company is investable. And I think what we aim to do with this framework is to help us with our decision-making process. Now, after using this framework, you still need to go on and do the valuations for the company. I think some of you who have followed the channel for some time, you would have seen how I have done my valuations in the past. And I use this framework first to decide whether or not I want to take it that step further to do the valuations for the company. Because the way we do our valuations is a lot more detailed. It's not just taking the revenue, applying some growth rate number to it, and then after that, just projecting out from there. We actually look at the business fundamentals and track those, and making sure the business fundamentals grow that justify the increase in revenue. So I'm going to take you through the 7 steps, and then basically I'm going to show you how we actually score the system. Now, very simply, one of the things that the previous framework did not account for is market cap. Now, why is this important? For me, market cap is important because companies at different stage of their business cycle should be regarded differently. So for instance, right, if you are a huge company and you're only just starting to build out your competitive moats in certain area, then to me, that is something that is a risk factor, right? Because you're already a big company, people are trying to gain market share from you. And if your moat is not completely built out, or, at least you're in the process of repeatedly improving your moat, then that's going to be a risk factor. However, if you're a young company, if you're a smaller market cap company, then I think with that, if you're just starting to build out your moat, I would actually think it's a good thing, right? That you're starting while you're still a small company, and then eventually that will grow into that certain size. So because of that, the market cap is important, and then how that will affect the scoring later on, I'll show you the back end of how this works. So basically, once you key in the ticker symbol over here, so Microsoft itself will actually give you the price of the company, market cap, as well as the PE ratio. This market cap, if it's basically you use the very standard way of segregating companies, right? I think $2 to $10 billion are mid cap companies, 10 billion to 200 billions are large cap. So when I say companies that are large cap and mega cap over here. Okay, so for example, let me just change this. If this is a 9.9 billion company, you can see that this changes to mid cap. If I say that this is a 20, so the numbers here are in billions. Okay, $20 billion becomes a large cap company. So with for Nvidia, this is a $4 trillion company. So you can see that's why it's 4,000 billion, right? It's in billions. Okay, so that's why this is considered a mega cap company. So this is how the scoring system will go. And then based on that, the scores will actually change in different sectors. Now, we start off looking at the total addressable market because if you listen to what Peter Lynch said, I want to give this enough credit such that, you know, it is a factor in considering how we invest. But at the same time, Peter Lynch did say that, you know, it's okay to go for companies in a slower growing market as long as the company itself is fast growing. So, and these are usually the underappreciated opportunities. So because of that, that's how I try and, you know, that's how I try and skew this scoring, right? I give credence to, or I give importance to market cap, but then I also, later on, you can see that we give a larger importance to revenue growth being faster than market cap and things like that. So you can see, we want revenue growth to be at least 10x of new TAM, which means that if I'm making $100 million in revenue, the total addressable market must be at least $1 trillion, right? So 10x. So this is going to differ slightly. So you can see, when I am a large and mega cap, it usually means I have a larger revenue. Because of that, even if a mega cap's revenue is 5 to 7 times of the new TAM, I am perfectly fine with giving them a full score over here because you're already a mega cap, you're already the market leader, and I shouldn't penalize you because you are making a large part of the revenue. However, if you are a, let's say, mid cap, $9 billion company, and your revenue is already 5 or 7 times of your TAM, that means, you know, you might not have a big enough market to expand into. It really depends. So let's say you're $9 billion market cap. You're 5 to 7 times, I'll be giving you 1.5. If you're 5 to 7 times of revenue and not unlocking new TAM with your technology, unlocking new TAM means that you're creating new verticals within the addressable market. So think about AI, right? We're unlocking many new verticals, many new types of businesses. If you are 5 to 7 times without unlocking new TAM, you get 1 point. And I'm penalizing the smaller companies if they're going after a smaller market for the start. So this is what we have. And then with that, so for NVIDIA data centers projected, depending on which paper you read, some papers say around 12% CAGR through to 2030. Some papers say 21, 22. So I take an average of around 15 to 16 times CAGR, which is why this only scores 1.5 for NVIDIA. NVIDIA's revenue growth, definitely at least 5% above 10. They say 5. So, you know, easily above. I think if the data centers are growing anywhere between 12 to 20%, NVIDIA is definitely easily growing more than 25%. Now, is their business model clear with growth drivers? I think their business model is fairly straightforward. I think what is a little bit for people to explain regarding NVIDIA is actually their technology, right? Not their business model. Their technology is hard. So it's actually hard to keep track of whether or not they still have a competitive moat unless you're very, very much in tune with the semiconductor industry. So that is the technology itself, not the business model. So I'm not taking away any points over here. Okay, then after that, let's see. Does NVIDIA have, okay, this one I haven't really filled it in yet. Does NVIDIA have a moat for switching costs? I would say that they have a moat for switching costs because they already have the proprietary software stack. So once you're already starting to use NVIDIA's system, it becomes very hard for you to change from somewhere else. Now, this is not a complete moat in the sense that, you know, people can, sometimes NVIDIA just cannot keep up with demand, then they will end up using AMD, and then they just have two different infrastructures over there. But by and large, people are not going to forego NVIDIA completely and switch to another company anytime soon, right? And then at the same time, I think the developers that are trained on NVIDIA's CUDA software, I think that itself is basically a lock-in for a lot of the workforce. So it's like the designers, right? A lot of them are using Adobe. So although Adobe charges a very exorbitant, subscription and things like that, a lot of companies have no choice. They either have to retrain their whole workforce or stick to using Adobe. So that is something that we have to consider for as a mode as well. In terms of network effects, does NVIDIA have network effects? I mean, I would guess so. Yeah, there's more as if there's more. Okay, network effects over here. I don't think it's about the number of people using NVIDIA, but I think the number of developers that are trained on their CUDA software. I think that itself is a network effect. Perhaps not the strongest. I don't know. Maybe people who are more in tune with the semiconductor space. I can tell you my approach to semiconductors because I like to invest in companies that I can track stuff. So, for example, SOFI in banking, rates changes. It's very easy to look across all competitors to tell who is the best. Is there a company out there right now that is incubating a technology that can beat NVIDIA in the next 3 to 5 years? I don't know. I don't see it now, but I'm also telling you, I'm aware that for my knowledge of semiconductors in terms of the technology stack, I'm not at a place where I can identify a new technology that can replace NVIDIA, which is why the way I'm approaching this is, you know what, I'm just having a small position in my other portfolio, and then where it's a buy and hold position for me. So network effect, I would consider this as the moat is being built up, right? I think the more developers are being trained on NVIDIA software, that's great, but there are other companies out there as well that I know, like AMD are also improving their software. So is people, of course, will tell me that are invested in NVIDIA will tell me that, you know what, NVIDIA software is the best. People who are invested in AMD will tell me, you know what, AMD software is catching up. So everyone has their own narrative, right? And like I said, I don't have the expertise in this area to know for sure. I just know these two companies are going to be number one and number two, at least in the foreseeable future. So that's how I'm approaching this. Okay. So give them 0.5 for that. Low cost advantage. They don't really have a low cost advantage over here. I wouldn't say that is a very relevant. I wouldn't say that's a very relevant mode for them. So that's why you can see 0 points. Now I'm choosing not to penalize companies for modes. There are certain industries that just don't have certain modes just by virtue of the industry that they are in. So because of that, I don't think they should be penalized for not having a mode if other people don't have a mode as well. Right? Economies of scale. They definitely do have economies of scale. Why is this a clear and defensible mode? I think if you have followed my AMD commentary in the past, you would actually know that, you know, when these companies work with like Taiwan Semiconductors to manufacture their chips, because NVIDIA has the larger demand, they put in the larger orders. Their orders tend to be prioritized over some of the smaller companies. And I think that itself gives NVIDIA a competitive mode, because if you imagine TSMC is always producing your chips first, always giving you first priority over some of your other competitors, then that is over time going to build a bigger and bigger mode for your company against your competitors. And so that is where I would say that, you know, this is a mode that people actually discount. And I think it's not going to be very easy for someone else to come in and overtake them. Now, regulatory framework, these two over here, capital and scale and vertical integration, these two are actually new segments that I've added. Vertical integration, I think this is a clear mode for NVIDIA. Vertical integration is very different from low cost advantage. I think low cost advantage is during your supply chain. You know, perhaps you have certain things that you make your cost low. Now, vertical integration, one of the benefits can be a lower cost, but I think there are other benefits apart from cost when it comes to vertical integration in terms of customer retention and things like that. So basically, NVIDIA is not just a chips company. They basically provide you with the whole stack, right? They have the software stacks as on top of their chips. And so because of that, the whole system is vertically integrated. And then they deliver everything right to your doorstep. And so to me, I think because of that, I would say that it makes their products very sticky, because you don't, install their software and then use another, you don't install their hardware and then use another software. You use their software. It's like basically Apple and their iOS. So to me, that is definitely a moat. Capital and scale, again, if someone else, I think if you listen to the way Jensen talks about how NVIDIA deploys their GPUs, scale, the level of expertise and the amount of money it takes, I think in order for someone else to want to disrupt them, they need to be able to burn as much capital. Now, in order for this other company that hypothetically wants to compete with NVIDIA to burn this extra money, they need to have a technology that is superior, that investors think is superior to NVIDIA, that they are willing to give this company the money to burn, right? So these are things, like I said, to me, has become a moat for them. Now, regulatory framework. I would say the moat is being built out. What regulatory framework am I talking about now? A lot of these companies are American companies. Now, the regulatory framework is actually sale of these chips to China. And the moat is being built out because you can see Jensen is really, out there, I mean, in a sense, kissing Trump's ass and things like that. And basically just to say that, hey, can I sell chips to China, pretty please? And I think that's become a moat. Because of the scale and the size of NVIDIA, they are able to make that ask to this current administration. We are able to provide this to the US. So because of that, can you still let us sell to China? Not every company is in that position to make that sort of request to the current administration. And because of that, they may be a little bit more hampered by these regulations over here. Now, intangible assets, things like brands and technology, to me, clear and defensible mode. Now, like I said, when it comes to technology, I'm not the best person to ask regarding semiconductors. I like semiconductors as an AI play, as a pick and shovels play for AI. However, you're asking me the technology. Do I know which technology is better and all the different specs? Honestly, I'm not that interested into to understanding that. I just know that this is the long-term trajectory, and then that is where I'm investing in. I'm taking a very broad approach to AI, right? At least the semiconductor side, because I believe in there's going to be a cyclicality. I just don't believe that it's going to be as soon as some people claim it is. I think people who have missed out in the AI revolution, they are pretty salty. So everybody's trying to say that they're going to pull back. They're going to pull back. But if you're listening to the earnings call of some of these companies, nobody has said that they are going to pull back. They may slow down, but they're still spending, right? So that's only. Yeah, I think that's only reasonable. Now here, this is the income statement. Revenue growth trend over the last 3 to 5 years, above 30% CAGR. Yes, more than 3 revenue drivers. Okay, this is where we have to take half a point off for NVIDIA. They do not have more than 3 revenue drivers, each contributing 30%, because the main one comes from data centers, although it is a very dominant revenue stream, and they have such a big moat over there. Customer accounts for more than 10% of revenue, stable gross margin above industry average. This is true because you can see in terms of their gross margins, NVIDIA is much higher than companies like AMD, and then decreasing OPEX. They are more than that, stable and decreasing OPEX below the industry average. That's why they're basically the most profitable semiconductor company out there. If you don't give them full marks in terms of profitability, yeah, who else is going to get full marks? Okay, over here, this was just my note. Low cost advantage can be because of scale, automation, location. Yeah, okay. I already mentioned this. Okay, so the next part over here, for those of you who have followed, like I said, every time I did this, I always say I need a ratio. So here it calculates the ratio for me. We are looking for a cash to debt ratio. That means I need to have more cash than debt of above 1.2. Now, if it's above 1.2, you're going to get a full 2 points. If you are between 1 and 1.2, you'll get how much will you get? Between 1 you get 0 if you're between 1 and 1.2, which means it's not a good thing, but neither is it bad. So it's neutral. I use negative scores only if it harms the business. So in this case, if there is more debt to cash, I minus 2 points. So for example, let's say this is NVIDIA's cash on hand, around $56 billion. If let's say they only have $5 billion, then this becomes a minus 2. Why am I penalizing the company so heavily? Because if you got less cash than debt on hand, then you are definitely at risk of bankruptcy, right? So we are burning cash. So that's not something that we want to see. So it does harm the investment thesis. Okay. So similarly, I forgot to mention this. In the moats category, if it's not relevant, it's 0. If it's early signs of moat, okay, for a big company like NVIDIA, I'm giving 0. But if this is a mid-cap company, for example, this, you can see early signs of a moat over here, becomes 0.5. Because like I said, I can understand a big company building out a new moat, but it's not a good thing. Okay, you should have already built it out, but neither is it harming the company, so I'm giving it 0 points. However, if a company has a weak moat, which means that you should be having that moat, but you don't, or your moat is easy to replicate, then that is when I will take away a point, because your moat is worse, objectively worse than your competitors. It's not that there's no moat, or it's not that you're just building out the moat and you're just a little bit slow. It's just that you already have a moat, and that moat is weak and easy to replicate. Okay, so that's for me how I look at it. Then goodwill to equity. Okay, this one, in the past, I used goodwill to assets, but I realize this is not necessarily the best case to look at it, because what I am actually worried about, or what I'm trying to quantify over here, is the risk to the shareholder. So what I've done is to use goodwill to shareholders' equity. That means you take the assets, you less the total liabilities, you end up with shareholders' equity, and how much of this is goodwill and intangible. Because in any case, this amount can be written off from shareholders' equity, and it's going to hurt the shareholders. So because of that, I went to look at certain books and certain references. Certain people say below 20%, some people say below 30%. So the range I've given it is, as long as this is below 30% of overall equity, they get a full point. If not, they get 0, and if not, it gets -1, right? Which means that if you have a huge goodwill impairment, you lose too much value for the shareholders. Okay, so this is where I will start to. This is where -1 is because it harms the shareholder, not to do because of it's harming the company. Cash flow over here, I'm giving it 2 points each for operating cash flow growth as well as free cash flow. So operating cash flow is basically from net income, how you arrive at the operating cash flow. If we see this is positive and growing, it gets 2 points, right? Which is NVIDIA. Volatile but trending positive. For a mega cap company or large cap company, I'm actually giving them only 0.5, because as long as it is trending positive, I can't take away points and say that it is bad. But neither is it fantastic. It's all right. So for a large cap company, this is 0.5. Okay. However, where I'm a little bit more lenient, it might be with free cash flow. So for free cash flow margin, especially for smaller companies, I believe if this is mid cap and the free cash flow margin is between 0 and 10%, they get 1.5 points instead of 1. The reason is because you're a smaller company. I can't expect you to be optimizing your business for free cash flow, which is why I said it's so important in our framework to start off with understanding how big the size of the company is, and then to understand how to actually look at these different companies. Okay, how are all these numbers generated? Later on, you're going to see at the back. So this is NVIDIA's net income. Very simple. We already have the PE ratio, right? And then basically we work backwards from the PE ratio to actually get the net income in terms of each company, right? Because your PE ratio times your EPS gives you your market cap. So you work it back the other way around. Take the market cap, you divide by the PE ratio, you end up getting your net income. So basically that is why we have these two numbers over here. And then tangible equity, this is basically your shareholders' common equity, less all the goodwill and intangibles. Now, you can see over here, the result says false because there's no need to, let me just. Okay, you can see this over here. The reason why this is 0, like the capital ratios, asset quality, all these numbers are 0, because these are only things I analyze for banks, right? If it's a non-bank, like banks, we don't use cash flow because their cash flow is going to be affected by their lending activities and things like that. So we only use this when we assess banks, and we use cash flow when we assess other companies. Then it comes to risk management. Now, does NVIDIA need, founder-led CEO, yes, okay. Share buybacks, insider ownership, no problem. Okay, in terms of risk management for NVIDIA, reducing that, they have low to no risk over here. Exit unprofitable segments, low to no risk. To diversify suppliers and customers, low to no risk, I would say. Now, I think some people may consider TSM as a risk. Their bottleneck is TSM. But like I said, it has also become a moat for them because there is only one TSM in the world. Everybody is And if everybody is going to them and they are prioritizing NVIDIA's orders, that is actually a moat to them. So that's why I classify this as low to no risk. But I would also understand it if people say proactive risk management, right? But yeah, I would say low to no risk. Simplify operations, yes. Improve liquidity, there's no need. They are very strong in terms of their liquidity. Now, in terms of macro and regulatory risk, I need to quantify this over here. Like every company out there has macro risk. In a recession, every company is affected. Sort of. I guess if you are talking about, things like utilities and all that, they are not affected. But that doesn't mean that in other macro conditions, they're not affected. I think every company out there is affected to some degree by macro and regulatory risk. But I think what I'm concerned with is that in a normal environment like we are in today, okay, I wouldn't say that we are in a very bad economy. Economy might be slowing down slightly, but we seem to be in a strong economy. But there is still risk to NVIDIA. And what is the risk? Regulatory risk. Trump comes out and say that, okay, Jensen, stop selling chips to China. And then they're screwed, right? So that is regulatory risk on top and above the general regulation. Like tariffs, everybody is affected. So I can't penalize NVIDIA for the tariffs. But there can be regulations that are basically specific to that company, like you stop selling chips to China, they're screwed, right? And then that's why NVIDIA sold off a couple of times this year because of this China thing. So that is where I'm starting to penalize this. Now, I give them credit for proactive risk management. You can see Jensen is going with Trump somewhere today. I can't remember where they're going. They're going somewhere together. UK? Is it the UK? I believe they're going to the UK together today. So you can see he's trying to befriend Trump. Proactive risk management, right? It doesn't always need to be a systemic thing. You can just go and befriend the person that's making regulation. Proactive. Operational risk over here. I will say that I will penalize management for missteps and things like that. They so far haven't had any missteps, right? I would say that so far they haven't had any missteps. So I would say this is a low to no risk at the moment. I'm taking away points here only if management has certain missteps in the past. No unnecessary M&A, no problems. So you can see with this, they're around 36, which is an elite compounder. Okay, so that is how this is being used. Now, I just want to show you the back end of all of this. You can see this is the scoring over here. Even then, NVIDIA, they are not scoring obsessively like 39.5 out of 40 and that kind of thing. And the reason is, I think we have to understand that every company has certain things that are definitely its strengths. There are certain things that are weakness to this company. And so because of that, I think it is reasonable. Even for a company as strong as NVIDIA, it still scores 36. It is on the elite compounder stage, but it's not so high on that scale where it becomes unreasonable because it's still, I think, fairly accurately represents the risk. So I would say that if some people that are still worried about the TSMC risk, you can take points off here and operational risk because these two can represent the TSMC risk, but even then you get 35, right? So even if you account for the risk of TSMC, they are still fairly strong because they are. You have to realize that the company is not. I think sometimes when we listen to the news, we are just focused on that one piece of news, but the companies have many moving parts, and maybe certain things are a weakness to the companies, but it's made up by strengths. So, for example, let me give you an example. Robinhood faces regulation risk because they're expanding into the UK. Now, would you rather them not expand into the UK and not have any regulatory risk? Because personally, as an investor, I would rather Robinhood expand into the UK and have extra regulatory hurdles that they have to cross compared to Robinhood staying in the US and having less regulatory hurdles. Right? So these are things that you have to understand as an investor. The framework can't fully quantify everything. How I've done this framework is that I've worked backwards from, I tried to think back about how I chose SOFI, how I picked HIMS, how I picked Palantir, and then tried to do something that hopefully we can use and track moving forward. Okay, so over here, what you're going to see is that there's two scoring systems over here. For large and mega cap, there's one scoring system. Micro caps to mid caps have another scoring system. So for example, one of the things I want you to pay attention to is in the total addressable market space. In the total addressable market space, if you are a large and mega cap and your revenue is only 5 to 7x of the total addressable market. As long as you are unlocking new TAM with your technology, with your products, with your services, then I'm giving you full credit. However, if you are a micro to mid cap, then I'm giving you 1.5. Now, the reason is not because a micro or mid cap company cannot go after a smaller market. They definitely can. But if you are a micro to mid cap and you're going after a smaller market, it stands to reason that there's a lot more competition that you have to, in a sense, overcome in order for you to gain a bigger market share. So because of that, I'm not penalizing it because it's a bad thing. I'm penalizing it because it's even more difficult. Of course, a lot of these companies eventually will, start off in a very niche area, and then after that they broaden out, which is why companies grow, right? They start off as micro to mid cap, and there are risks involved in the investment. So perhaps they may be, in story-driven segment of the scoring at the moment, and over time they improve in their scoring, and then that's where you find these companies more investable later on, depending on your risk appetite. Okay, similarly for CAGR, if you are in a micro to mid cap going after a slow growing CAGR, definitely I'm going to be a little bit more concerned, because you're going up against the incumbents, and if the market is not growing as fast, you really need to be very, very differentiated from the incumbents. Okay, so that's how I look at it for micro and mid cap. Now, that's not the only thing. If you look at the moats, you can see for micro and mid cap, if the moats are being built, or clear and defense, I don't expect micro and mid cap companies to have clear and defensible moat. I don't. It is very, very unlikely to have it. Usually only large cap companies tend to have this. Micro to mid caps, usually the reason why you are a micro to mid cap is because your moat is not fully built out, which is why I'm giving you credit if you are taking active steps to building out your moats. Now, early signs of a moat, I will give you a little bit of a credit, because there's no guarantee that the moat will actually eventually be built out, right? So with moat being built out, it's like you more or less can see the moat is just not as good as the big boys. So yeah, but because you're small, I'm giving you credit for that. So that's basically the difference over here. If you are a small company and you still have a weak moat, like I can't see why would someone choose your company over a bigger company, then definitely it's a negative. Similarly, for revenue trend, this is very straightforward. Okay, why am I penalizing the smaller companies for revenue growth? Very simple. If I can buy a large and mega cap company growing at 20 to 30%, why am I spending money on a micro to mid cap growing at 20 to 30%? I can buy SOFI, a $30 billion market cap company growing at 30%. In the last quarter, 40%. Why am I buying a mid cap company growing at 15%? So, but again, like I said, you're looking at this in isolation, because Klarna's IPO, interesting. Okay, I think I'll definitely check out Klarna's IPO. It's one of those buy now, pay later. I'll be interested to look at them compared to Affirm. I think I remembered when I was talking about Affirm, the next day they actually released their earnings. They had fantastic results. Stock jumped from $81 all the way up to $100. But then today, I believe they're down back to around 84, 85. And after the results, that's why I think Affirm is one of those companies that I have on my keep an eye on list. Later, I'll show you a list that I have. So with that, that's how I look at the income. That's how I look at the revenue trend, right? So that's how I tend to think about it. If you disagree, please feel free to let me know below. Over here, gross margins, growing gross margins for micro to mid cap, I'm giving credit. Whereas in large to mega cap means you're still finding your space. Where are you going to level out? Then to me, that's a 1 point instead of 2 points, right? Because when you're large mega cap, hopefully you have stabilized your gross margins. But it's not necessarily a bad thing. It's not necessarily a bad thing, right? So, like I said, don't take the framework as the end all be all to this. If they score story driven means they're not investable. I think you have to understand this framework tells you which part of the life cycle the company is at, which part of the business cycle the company is at. This together with a proper valuation process will then tell me that, hey, maybe this company is investable, right? Because maybe if I go through this framework, this company is actually a story driven company. But in terms of valuation, it is so compelling that I'm willing to take the risk. What this does is to filter out all the ridiculous companies that are a lot more risky, right? Yeah, and to make the very like preliminary judgment of, if I can buy SOFI growing at 40%, why am I buying a mid cap company growing at 20%? The risk is not there. But of course, you have to bear in mind that at one point, SOFI was a mid cap company, but of course, when they were there, they were not growing as fast as well. So this is a chicken and egg thing. At the end of the day, these companies need to prove themselves with their growth. Once they put up the growth numbers, the market will recognize that and price them accordingly. Okay, so with this, you can see in terms of cash to debt ratio, nothing over here because most of this is done by the formula. I will just key in the goodwill and the equity, and then the formula in front will work it out. C1 ratio, I think those of you who have been following SOFI for some time, you know this fairly well, more than 12%, 10 to 12, and less than 10. So I penalize less than 10 because this is the regulatory minimum. 10 to 12, it's not a good thing because you are not you don't give yourself a lot of buffer, but it's also not a bad thing, right? And then free cash flow, you can see over here, I reward the micro caps a little bit more because I don't expect them to have very strong cash flows. So if they trend in the correct direction, generally, I tend to be a little bit more lenient with that. Whereas if you're a large and mega cap company, I expect your cash flows to be a lot stronger, which is why I'm a lot more I penalize them a lot more because of that. So you can see, I think the biggest one is in the free cash flow margin. If you are a large to mega cap and you have your free cash flow margin close to positive but volatile, which means you're fluctuating, I actually deduct 0.5. For micro to mid cap, I actually give 0. So to me, it's acceptable. Micro to mid cap, it's not good, but it's not bad. For a large to mega cap company, this actually tells me that perhaps valuation wise, if you are scoring very low on your free cash flow margins and things like that, and yet you're still at a very high price, it tells me that perhaps on a free cash flow basis, your valuation may be a little bit rich. Net interest margin, this is very similar. Okay, we just go to the FDIC. They release a report every single quarter, I believe, with the national average in terms of the interest rates, and then you just see the bank that you're looking at, right? So with SOFI is above the national average, so that's fine. CEO, all these are quite standard, right? So risk management, low to no risk, proactive risk management. Yeah. So that's how I get my scoring. Okay, I just wanted to bring you through. I've done it with HIMS. And I just want to show you something. Like for HIMS actually fell down after the most recent Nova Nonis. Now, previously, HIMS was under high quality. If you look at the scoring over here, high quality is 28 points. But recently, after some of the changes and the risk of all the lawsuits and things like that, HIMS has actually fallen down to story driven. So like I said, but if you see in my portfolio, I still hold 1,000 shares of HIMS. Depending on how it closes this week, potentially another 1,000. Now, Adobe, I like Adobe as a business. I am not 100% sure how AI will affect them. I mean, I'll be very honest. At the moment, it's on Excel because that's how I did it. I think next time I might try and put it on Google Sheets. Yeah, I'm more familiar with Excel at the moment. That's why I did it on Excel. So I'll try and put it on Google Sheets eventually so that I can share it with you guys. What I want to say, someone asked me, about Adobe. Okay, so with Adobe, I have a personal experience in the sense that I tried it and it's so complicated and I couldn't learn it. Like, I am not a design student by any stretch of the imagination. I did engineering, I did education, and I did finance. That's my path. Good evening, Jin Chuan. Good evening. Yes, so we are talking about the framework that we've been using. I've changed it from what we did last week. You can see basically we account for how big the company is, and then and then after that we have a slightly different framework. Okay, so when it comes to Adobe, I like it because I think it is a very sticky business, right? And a lot of it's, like you said, it's more for corporate use. And I don't believe like designers or design firms are going to retrain their whole task of workforce to go on to, like perhaps Figma. I know Figma is one of their competitors. Like for a moment, they wanted to buy out Figma, and then I think that didn't go through, and then now Figma has listed. So I don't think that they are going to retrain them despite just to save that cost, because the cost that they save from migrating over to Figma might be, might not be worth that time, might not be worth the pain and things like that. Yeah. So the government shut that down, is it? Okay. I didn't follow it that closely at that point in time. But I think I think for me, because I don't use the product as much, I find it a little bit hard. I do know it's very, very sticky. I'm not too sure how much growth they have in front of them. Yeah. I'm actually looking forward to Canva IPOing. I'm using Canva. I actually just subscribed for Canva Team so that someone else help me with some of the social media things, like hoping to post more regularly on Instagram and things like that. So I can see where the appeal for Canva is, especially for a layperson like me, for small business owners. Whereas for big corporates, then I got designer friends that frown at me from using Canva. I said, you're using Canva, but you know what? Yeah, I can admit I have gotten an 8 out of 10 for art in secondary school before. So you can roughly tell where my art exams, how artistic I am in terms of drawing and things like that. So I love Canva, right? So I think that's what I think about Adobe. I like it. I think it's a strong company, strong cash flowing company. It's a bit hard for me to assess their growth prospects. I think in terms of the corporate side, they are definitely strong, but in terms of the individual B2C, I'm not too sure whether or not they'll be outcompeted by some of the other products. 6 months to a year, I can see share buybacks are going to push EPS up. Yeah, definitely. Yeah, I think in terms of cash flow, in terms of profitability, not to worry. I don't see any close competitors. I think what we need, I think if you're investing in Adobe, what I don't know if there's a metric to track this, but you see, the big design firms right now are trained on Adobe. Now the question is, can Figma get into the new design firms that will eventually become bigger, and then you replace them that way? You don't replace them in the existing firms, but you replace them by entering into the new firms. So that could be something that eventually, over a long period of time, could Figma displace them? I don't know, because I don't use the products. I've never even seen Figma's products before. I know Adobe's products is good because I know people who use it on a daily basis. I have no idea whether Figma's products are Google's Nano Banana. Yeah, I do. I think I've seen the one where one of the there's this CEO. He posted this picture of himself with Lisa from Blackpink. Am I right? I think that picture went quite viral on LinkedIn or something like that. Yeah, so if Adobe has already, I think sometimes people talk about AI taking over some of these companies like Adobe, in terms of Duolingo. I think people forget the fact that these companies themselves, Duolingo, Adobe, these companies are not stagnant. They are going to integrate AI as well. So you need to integrate AI at a factor much faster and much better than them in order to outcompete them. Otherwise, they're going to do it as well. Yes, correct, right? So I was right. I think I just saw that earlier today. Yeah, it went viral on LinkedIn. So yeah, I'm really quite impressed with Google. I mean, yeah, I feel like this year is finally a year where a lot of the picks that I have had in the last couple of years has been paying off. Companies like Google and AMD are in my parents' account that I just buy and hold for them. They've been buying AMD in the $100 range, Google in the 150s, and then they're finally seeing the payoff, because it was quite frustrating for a while, like 180, 190, and then drops back down to 160. So I kept buying more, and then so I think thankfully they are seeing the payoff right now. Yeah, Google is really a machine, and I think I think people really discounted them. I think the reason why a lot of investors were afraid has nothing to do with all the all these constant headlines that you hear about the loss of search and things like that. I think we can agree that search is changing. The problem is Google itself is also changing the way they do search, which is why they have integrated. Now I just look at Google AI overview, right? Rather than just actually scrolling down the links to search for the results. So I feel like search has changed. And I think you look at Google, that is exactly what I mean by the incumbent companies, the leaders in their space are going to be using AI as well. People are talking about it as if these companies are not going to use AI. Yes, I am on X. You can see my X is at the bottom over here. It's Elijah Cheng. It's my full name. Yep. Okay, with that, let me quickly just touch on HIMS, and then I'm just showing you how this valuation is fluid and how I think about it. Yeah, happy to connect more on X. Free to add me. I'll be posting more. Like I said, at the start of the 10 days, I have actually scaled down, I would say, 80% of my 9 to 5, such that I'm playing a very minor role. Yeah, I'm not really taking on new customers anymore. So because of that, I have a lot more time to, and I've streamlined my customer base. So I have a lot more time to be on YouTube and things like that. Yeah. So, okay. Let me very quickly bring you through how I look at HIMS. HIMS actually fell for me from a high quality company to a story driven company. Now, that hasn't changed my investment thesis. Like I said, I don't make decisions just based on this framework alone. I look at it really based on this and the valuation, and to understand that sometimes some of these changes are just reflective of the particular transitional period that the company is in. And as long as they can transition out of that period successfully, then I think they are going to do well in future. So HIMS, they are in the healthcare, telehealth, telemedicine space. Definitely their revenue, the total addressable market is 10 times of revenue, more than that. Now, over here, the CAGR is around 19 to 20%. Yeah, I think depending on which vertical you're looking at. So this is a little bit harder for me to actually project out. I've seen, because they go into so many different verticals, but in healthcare in general, it's around 20%. Revenue growth, 5% above 10, agreed. Easy to understand business model to me, yes, right? They go, I mean, if you look at their revenue breakdown, it's so easy. It's just subscription, the majority of it, and then they have a bunch of wholesale. Okay, so from here, again, switching costs, I will give them 0.5. The moat is being built out because of personalization. I believe that once someone has personalized your drugs on HIMS, it's very hard for you to want to go to somewhere else without that sort of personalization, especially if the personalization is required. So, for example, in the past, my grandma couldn't take pills. You had to take certain medication in liquid forms, so it was hard, right? Because we didn't have such options in the past. Now, with HIMS, you now have that options, which will make switching out a lot easier, right, to the medication that suits you. So because of that, if a patient has already found a medication in a form factor that suits them, in a dosage that suits them, then that is something that is going to be sticky. So the switching cost is not necessarily a financial cost per se, but these things that make the customers sticky over time. Now, network effects, there are early signs of a moat over here. Why I say that? Because what HIMS does is that they cross-reference all the different data points from the patients that they have in order to make recommendations for other patients. So, for example, they said that men, if you suffer from certain conditions like ED and all that, or hair loss that may be leading to other cardiovascular problems that are yet unidentified, and because of that, they're able to take preventive measures to help people protect against these things. Now, it's very hard for me to gauge the impact of that. And now they're only starting out to build into different verticals. It's very hard to see the full impact of that, which is why I say early signs of a moat. Okay, low cost advantage, definitely. They own their own pharmacies and things like that. So moat is being built out. Economies of scale, like I said, as they expand their business, definitely, they are going to be experiencing the benefits of, becoming a bigger and bigger company. Now, vertical integration, to me, this is a clear and defensible moat because they take care of you all the way from seeing the doctor to handling a prescription to delivering it, and then after the after service care as well. So to me, this is something that I think the main difference over here where they might lose to LifeMD, which we were covering previously, is that LifeMD gives you the same primary care physician. for people who want that, then this is going to be something that is a pain point for them. Otherwise, this is something in general. If you're just wanting to have one company serve you through the whole process, you are not that concerned about your primary care physician because it's not a serious condition. Then this is not a problem. So it serves different aspects of people. Now, capital and scale, early signs of the moat. Like I said, they're just starting to build out all their infrastructure, and they're still such a small company. You can see that they're trying to expand. Eventually, if they get to a large enough scale, then it'll be very hard for. It's like Amazon, right? The moment that they have built out their logistics network to the size that it is today, where they offer same day delivery or even like within 7 hours or something like that, then for another company to come in and compete in the space, they need to be able to build out a whole network logistics systems of that. So similar for HIMS, if they build up their manufacturing capacity up to a certain size, then it's going to be very hard for new entrants to come in and to produce compounded drugs at the same scale as them. Regulatory frameworks. This one I said early signs of a moat. Okay, why did I say that? I think over here, some of you may choose to deduct a point for weak moat and it's easy to replicate. But why I say early signs of a moat is that because if you consider the recent ruling of the judge, they said that these compounders he already set a precedent that these compounders have the right to compound as long as it is prescribed by a doctor, and it's not because the patient didn't look for them because they marketed their products through a prescription for a doctor. So they basically made the loophole for them, in a sense, for them to reach out to this. I wouldn't call it a loophole, but it's really for the good of the patients, right? You don't want the patients to be stuck with to pay for medicine that is actually not beneficial for them. So to me, this is a new development. I want to see how it actually plays out. So I say early signs of a moat. HIMS in 5 years, good question. Definitely over $100 for me. That's what I am expecting. Whether or not that actually plays out, I don't know. I will be going through my exact valuation later on this week so you can see how we get there. But I'm basically using the management's 2030 projections. My assumption is that I think in this last quarter, they have given reasons why they have missed their own guidance for the first time. At least I think they missed the high end of the guidance. They didn't miss the low end. But this was the first time that they actually had a weaker quarter. A lot of it is down to the Novo Nordisk partnership and some changes in terms of their product mix. I will cover that in the valuation, and then we see what it takes for them to get to their 2030 goals. Now, then if they get to the 2030 goals, what is the valuation over there, right? So I would say easily $100 over dollars, but how much exactly? I need to do the valuation from there. Intangible asset, like I said, brand, definitely to me this is a moat being built out. This is very popular in the US. I believe as they are expanding out, this is one of those companies that they just have a very strong marketing team, and their marketing spend is decreasing year over year as a percentage of revenue. So this is going to become even more scalable as it gets to a bigger company. Revenue trend above 30% CAGR, this has no problem. Revenue drivers more than 3, because it really depends. They have men's health, and then they go into hair loss, and then they are getting into menopausal and things like that this year. So there's so many revenue drivers, right? GLP-1s, yes, to a certain extent now they are being taken out. So you can actually see that they scale. Even their oral weight loss solution itself is scaling into a relatively important aspect of their revenue already. So to me, this is a company that I see many different revenue drivers for them. No customer more than 10% of revenue. Stable gross margins above industry average. I believe their gross margins is in the 70% range. Let me double check. HIMS in my dashboard. Yeah, so their gross profit margin is over here in the 70% range, right? So this is higher than the industry average. I believe the industry average isn't even that close to 70%. Let's take a look. Industry average. Yeah, I was looking at the gross margins over here. So you can see, in terms of gross margins, they're much higher than everybody else. Like I said, this is one of the reasons is because of their vertical integration, right? So personally, I am not too concerned over here in terms of their margins, giving them full marks for this. Okay, that's where we are. And then let's go back. Okay, this is their cash. Now, long-term debt. You see, this is where they lost the point. Now, previously, they had close to zero debt, which was why when they had zero debt, this was 2 points. They actually lost it because they issued some senior convertible notes. And again, this is one of those things where the framework can't account for everything. This is a piece of worksheet in Excel. Does 1.2 and 1.19 make a big difference? Honestly, no. But because I need to give it a number, it's just zero because now they have this long-term debt, which is a senior convertible note, which they have used to acquire. They take on all these debt to acquire companies like Zava and to actually grow the other aspects of their business. Is it a bad thing? It's not a bad thing, but just because of this, you can see if I plus 2 here, you end up getting 29.8, which then brings this back into the high quality company. So like I said, not every time that this drops down to story driven, that means the company is actually, getting worse. Okay, then next thing, goodwill, no problem over here. Free cash flow margin. Why is it 1 point? Very simple. Let me bring you back to Fiscal AI to take a look. Once you take a look at this, okay, let me take you to financials, cash flow statement. Let's take a look at the free cash flow. If you take a look at the free cash flow, let's just look at it quarterly. You can see even more clearly. You can see that this was actually growing, and then it dropped, and then it became negative. And it's because of this one negative that I've decided to take a point off from their free cash flow. Does this mean anything? Not really, because if you listen to management, you would know that they have really invested heavily into the business this quarter, and they expect to go back to cash flow positivity in 23. Sorry, not 23, in Q3 and Q4. So is this a big problem? No, but it fits the description of having slightly volatile cash flow, but trending in the positive direction, right? Rather than always always growing. If this came down in this range in the 60s to 50s, then I had no problem. But because it didn't, because it went all the way negative, I felt like in order to be intellectually honest, I need to actually take away certain points for them over here. And then basically from there, this is another point. So you add this 2 to this, HIMS is actually still a 30.8. And if these are 2 things that you can look past, the free cash flow dropping negative for 1 quarter, which they will inflect back to profitability next quarter, as well as the senior convertible note. I mean, if you look at how their stock responded after their Q2 earnings went all the way up to $60, that basically tells you everything you need to know about how good their last earnings were, right? So this is not something I would be too particularly concerned with. And then at the same time, this one, founder-led. Okay, the only thing over here is that I took away points for this regulatory risk because macro and regulatory risk. Sorry, this was the version because you really don't know. I think sometimes with pharmaceuticals, you just have to accept that it is going to be an inherent risk around all the FDA regulations and things like that. They're always liable to be sued. To me, this will always be a -5. There's nothing the management can do over here that will completely remove the risk. If you want them to completely remove the risk, then they might be growing at a slower pace. So, you really have to, in a sense, pick your battles. So over here, I am accepting the fact that this will always be an inherent risk of the company. Because of that, that's why they are only 10 to 15% of my portfolio. Similar to Oscar, very, very dependent on, the ACA subsidies and things like that. Because of that, I only allocated around 60, 70K to... Basically, I've invested around 60, 70K to both HIMS and Oscar. It's just that Oscar has grown much faster over the last couple of days because of ACA. And this exactly represents the risk inherent to the company right now, right? And then you can't blame them for the longevity thing. This is zero, right? They survive one economic cycle, which is during COVID, but they're not this is just a factor of time. As you prove yourself, as the company continues to grow and prove themselves over time, it's not going to be a problem. So you can see they lost 2 points from taking on senior convertible debt, which is not a bad thing, and then they lost 1 point because I wanted to account for the free cash flow that turned negative in Q2, which will re-inflect back to profitability in Q3, right? Even if I keep this 1.19, I change this to 2 points, they are back into a high quality company. So does this really matter? No. Like I said, this is just a framework to give you an idea of how to choose companies. Now, like I said, I will have to pair this together with a more detailed valuation. I will do that for SOFI as well during the week. With that, I will bring tonight's live stream to a close, but just to let you know, tomorrow morning, Singapore time, around 9, let's call it 9:30. Okay, I'm going to call it 9:30. 9:15, 9:30, 9:30. You know what? I'm just going to say I'm really a night owl, and I'm trying to change my sleep schedule so that I'm sleeping a little bit earlier. And I'm going to do a morning live stream, morning Singapore time, night time for people in the US. I'm going to cover very quickly why I have decided to open up to not roll that Lululemon position and to just opening up and what I'm actually looking for. It's not going to be a very long stream, hopefully about an hour long. I'm not going to do what I did like at the start here, go through my portfolio position. I don't think much will change between now and then. It's just a couple of hours. But yeah, that's all there is, right? I'm going to do Lululemon tomorrow morning, Singapore time. And then tomorrow at night, we'll be taking SOFI through this exact framework, plus looking at the valuation. Because I think earlier on, you saw my screen. I was listening to the fireside chat that Anthony Noto did. I think Tanner was listening to it on his channel. I haven't listened to it yet because I was busy today, but I will have a listen to it, include that into tomorrow night's stream as well. So with that, I think that's all for today, and that's all for now, and I will see you in the next one.